Good afternoon, everyone, and welcome to our webinar, The State of the Healthcare M&A Market, hosted by Levin Pro HC, the comprehensive M&A news and data platform that tracks all the healthcare sectors from home health and hospitals to physician groups and medical real estate. And we have been doing that since 1993 with our transaction database. So very happy to have you all on. I am Ben Sweat, the managing editor of the Levin Pro HC platform and its associate publications. And I am delighted to be joined by several experts and big names in the field of M&A today to dive into the numbers and themes that defined the 2026 healthcare M&A market so far, what's changing, what buyers and sellers should be ready for as they strategize their next M&A moves. Before I introduce our panelists, just a couple of quick notes. First, if you have any questions for our panelists throughout the call, you can enter them in the Q&A box in the Zoom window, and we'll do our best to get to them throughout the call. We're targeting an hour and 15-minute conversation, so do try to stay for the whole thing. I'm talking to the audience here, guys. But if you have to leave us, we will send the recording to all attendees afterwards, as well as the slides for today's call, which you can also find in the chat window shortly. Lastly, a survey will appear at the end of today's call, and your answers inform our future webinar topics, and they also help improve our future calls. So thank you in advance for filling that out. And if you have any questions about our healthcare news and data, feel free to email us at info@levinassociates.com or just head to the website you can see here on the slides. Now, without further ado, on to our vaunted guests. First, John Tiedemann joins us from Physician Growth Partners, where he advises on transactions for everything from physician groups to healthcare services organizations, helping his clients navigate the private equity landscape and ultimately maximizing their transaction outcomes. Very glad to have you on today. Welcome, John.
Thank you.
And next we have Bill Hoffman, who is a shareholder at Polsinelli. With his experience, Bill is able to distill complex regulatory, reimbursement, and M&A trends in the healthcare space to help his clients solve difficult problems with practical solutions. Yeah, he's also growing his practice in these spaces and helping his clients do that too. Bill, hopefully you've been able to dumb down some of those complex trends for me today. So I sincerely appreciate it, and thanks for being here.
I'll do my best.
I have no doubt. And last, but maybe the MVP of today, Matt Bogle, with around 24 hours notice, stepped up to fill our last panelist spot after Zach Schrock was unable to join us due to a family emergency. And I hope to have him on a future call too. But Matt joins us from Intrinsic, a healthcare transaction advisory and valuation firm where he is a managing director at the transaction advisory services practice and is the leader of the healthcare services team. He spent more than 10 years advising clients from the PE, investment banking, and provider worlds across many sectors in healthcare. So he rounds out our panel perfectly. Thank you very much, Matt, for the hustle and joining us today. Hope you got some sleep last night.
Absolutely, Ben. Happy to chat through this, and yeah, thanks for having me.
Absolutely, we'll have some fun today. We have a lot to get through in the conversation, and with how general healthcare is, we'll try to zero in on a few sectors as well and cover some of our latest M&A stats featured in our healthcare services acquisition report, which was published last month. We'll also check in on the private equity industry and what they're targeting right now, how health systems will evolve as investors, and what physician specialties are hot right now and which are not. And of course, we'll try to cover our audience questions too and any other topics in between. So certainly a lot to get to, but I want to start off generally. We see here in our chart of publicly announced healthcare mergers and acquisitions from the last 5 years, we see that healthcare M&A has stayed relatively consistent in the last several years in terms of activity, but it's fallen below the activity levels of 2021 and 2022. This first question is directed to all of you. Matt, if you want to take it first, what has been the number one reason for this underperformance relative to the market peak? Is it liquidity? Is it, a combination of regulatory reimbursement concerns, fallen investor interest, or something else?
Yeah, happy to take that one. So, I would say the most obvious issue has been just the rise in interest rates, making deals kind of harder to, finance. And also, probably a little bit of snapback from the kind of post-COVID bust where, valuations got, really out of whack. Um, and it's probably, burnt a few folks that are being just more disciplined, today than maybe 2 or 3, 3, 4 years ago. But the interest rates certainly have been probably the biggest hurdle, and I think folks have certainly gotten creative in how they're financing deals, shifting deals to have earnout components maybe more frequently than years past. But I think mostly it's kind of the interest rate environment, and then also just kind of that gap between buyer and seller expectations when it comes to valuation. Certainly seeing that gap closing some.
Mhm.
And then folks, they talk to their friends, oh, hey, I sold my practice for, 15x. Well, they probably actually sold it for 10, but still, more realistically, it might be 8 in today's market. So, there's a lot of, gap there that, requires some education and some marketing and things like that. So I would say that's probably the primary driver. I know most of our clients are still trying to, be active and do deals, and we're certainly seeing the activity starting to pick up and having more folks wanting to go to market on the sell side. But I think like the most obvious and biggest issue has been, probably the interest rates.
Bill and John, did Matt hit the nail on the head?
Yeah, I
Yeah,
think
I
that.
would.
Go ahead,
Oh,
Bill.
John, you go ahead.
I think he did. I think that, the biggest observation in what Matt said is sort of the snapback concept, right? I think if you blew this chart back further, the last few years wouldn't look like such a hit compared to 21 and 22. But
Mhm.
you had the pent up demand from 2020, right? You had a lot of folks looking at healthcare and healthcare services as an area to, step back into investing from a private equity standpoint. And so there was a lot of froth in those, 21 and 22 in terms of, valuations were high, which meant that there was a lot of transaction volume. Every seller was a seller in that market, right? And then all of a sudden, interest rates go up, uncertainty, buyers are getting more careful. The bid-ask spread got very wide, if you ask me, and that was really what drove a lot of the slowdown. Matt talked a little bit about that, is the idea that sellers had in their minds those sort of peak valuations and buyers were, getting very conservative from a risk management standpoint with interest rate fluctuation, with, did we get a little bit too frothy and, do we need to sort of rebalance the portfolio and look outside of healthcare services for a minute and sort of catch up in sort of our portfolio theory and how we balance our investments? All of those things needed a minute to normalize, right? And so now today in this market, I think what you're seeing is, the average multiples might be down a turn or two, but still, flight to quality, right? The high quality assets can still command, a nice valuation. Whereas the lower quality assets, buyers are more tuned into what does that mean and where did folks get burned to Matt's point and how and let's make sure that we're paying attention to that and just being a little bit more thoughtful in terms of valuation. But as that bid ask comes back together, you start to see that volume pick up again, right? But if the bar wasn't set so high, I think, the last few years wouldn't look nearly as down, if you will,
Yep,
on a relative basis.
Yeah,
absolutely. I agree.
and I would agree with John and Matt that the bid ask spread is certainly narrowing after several years of it remaining, frankly, very wide. But I would also add that there are macro environment issues that are still making buyers nervous and making LPs a little trepidatious about investing into funds that are healthcare specific. I think the biggest issue is essentially labor costs.
Hmm.
Healthcare is a very labor intensive industry. Shortages in nursing and specialized clinicians have caused wage inflation that CMS and other third party payers have not kept pace with those inflationary increases in wages. And it has resulted in EBITDA suppression and an issue where people are looking at healthcare and saying, We don't want to invest in such a labor intensive business. And if we do want to invest in healthcare, we want to look more to the tech enabled side of healthcare instead of hospitals, PPM, and other labor intensive aspects of the healthcare sphere.
Yeah, just to
And
tack on one more kind of trend here that we're just been seeing over the last few years is just the buyer's appetite for believing pro forma type adjustments when it comes to selling a company. Maybe in 2020, 2021, it was like, hey, we've got an offer outstanding to three docs. They're about to sign up, and their average margin profile is X, and their specialty historically has generated Y amount of revenue. So we want to get paid on that because we've recruited those physicians. Well, in today's day, we have to be really strategic around what kind of pro forma adjustments are presented on the sell side to make sure that we're not getting over our skis or not presenting concepts that just buyers aren't are going to throw out, because we represent a lot of private equity clients too, and we'll look through an initial sell side QOV workbook, and they'll go, yeah, we're not giving credit for that. We're not giving credit for that. We're not giving credit for that. Whereas, maybe 4 or 5 years ago, people were a little more willing to maybe believe some of those stories and be a little more risk
yeah.
tolerant.
Matt, do you have a couple
I
of
blame the
examples
investment bankers.
of some of those pro forma assumptions that you are not giving as much credence to right now?
Yeah, I mean, things like disruptions in the RCM department. If there's, hey, our collection rates dropped by 5% for X, Y, and Z reason, whether that's we had some turnover in the department, or we weren't clicking some box, and it's resulting in us getting more denials than we're used to seeing in the past. Today, until you have shown a large amount of time where you've proven out that you've fixed those issues, buyers just aren't giving credit for that. And even if you have shown that you've fixed those issues, some buyers that are a little more disciplined are still not stretching on things like that. So I would say pretty much any pro forma concept, ramping locations, ramping facilities. Everything's just getting looked at with a more of a fine tooth comb. And just buyers generally are being much more disciplined on what they're giving credit for. It's got to be something that is rock solid and proven out in historical data, and a lot of the forward-looking assumptions are just not being looked at the same way as they were maybe 4 or 5 years ago.
Yeah, that doesn't sound like necessarily a bad thing. A little more discipline in how we're pricing deals right now.
Just a lot less fun.
Well, I'm sure you guys are no less busy also. But John, for the headwinds that are affecting healthcare M&A and just the sheer activity in the space, is there any headwinds that you see right now, kind of especially lessening, that could lead to more of a boom in M&A activity in healthcare?
Yeah, I mean, yes and no. I think we came into this year with really high expectations that this sort of logjam was going to break, meaning the platforms that have been owned by private equity that need to trade from their first or their second private equity firm to their second or third partner, and free up some cap space, if you will, sort of reinvigorate the M&A strategy. I think some of that has started to happen, and part of that, we've seen a new buyer set come into the picture. Some of the distributors and folks that have gotten into the provision of care business, right, with some of the retina platforms and GI neurology and things of that nature. But I think there's more of that to do, more of that backlog to work through. As those things trade, you'll start to see second bites become reality, start to see value in rollover equity for some of the physicians who did deals in some of these platforms, right? Some of that all becomes sort of, I won't say self-fulfilling, but it's part of, at the higher level, when that activity starts, it will increase activity at the lower level, first institutional capital deals, some of our clients and things like that. I think one of the headwinds that we're starting to get more clarity on is, and Bill can probably help me talk about this a little bit, but some of the state-based regulation, right? There are certain states who have proposed, different levels of oversight, if you will, into healthcare services transactions and investments by private equity into healthcare services. There are states that have, tried to do various different mechanisms from, hey, you have to tell us that you're doing this and provide notice to, hey, we want to be able to approve this. I
Mhm.
think by and large, some of the concerns in most of those states have landed in a place that is more favorable for the private equity folks and the folks looking to do deals than in certain cases we were worried about. And so some of that clarity helps, on a state by state basis, grease the skids for more transaction activity. I think, the the other element that we talked about that has been a headwind is that bid ask spread.
Yeah.
That has been, the probably from my perspective, the biggest area of gridlock and hindrance to transaction volume over the last few years is you've got every physician who wanted to sell their practice thinking that, some, double digit multiple was the norm. And it takes a while to come back down to earth on that. And like I said earlier, flight to quality, the great assets will still command appropriate valuations. But overall, that feeding frenzy that was happening, that's come and gone, right? That was a peak, and we may not be back in that environment when you think about how low interest rates were, supply and demand of deals and capital trying to flood into healthcare services. We may never see that kind of feeding frenzy again in our careers.
Mhm.
But I do think as time has gone on and you've seen, the buyers sort of lean into where they want to be, knowing what they consider high quality assets, and the sellers, coming, I guess, in some ways down to earth, depending on the nature of their practice, the scalability, the quality, et cetera. And that's a lot of, what we do and how we work with our clients is to try to understand where the right expectation should be from a value standpoint. And as that's come together, you're starting to see that, unlock quite a bit from a volume standpoint.
Yeah.
And John, I'll build on your point with respect to state law restrictions, particularly with respect to corporate practice of medicine and healthcare transactions. And I'll kind of speak to those one after another. We have seen a substantial growth in state law. We call them mini HSRs that are essentially attorney generals for states heavily scrutinizing healthcare transactions and state legislatures passing bills that essentially require AG review. I'm going to be honest, those freaked me out a bunch in the past. But as we've gone through them, particularly in states like California, Rhode Island, it's been sort of a nothing burger. We have not seen many, if at all, any states that have actually blocked a transaction in the healthcare space. We've seen some that have been modified, but we haven't seen many, if at all, that have been stopped. So we were all very nervous about that 3 or 4, 5 years ago as those laws got passed, but it's been mostly okay. With respect to the corporate practice of medicine restrictions, 3, 4, 5 years ago, again, we were really freaked out. There were lots of states that were considering bills, Rhode Island, Washington, Oregon, California, Minnesota, that essentially would outlaw the friendly PC MSO model that has been used for 30 plus years. And fortunately, or unfortunately, depending on your politics, the PE lobby is incredibly strong. And the only state where that law has actually passed is Oregon. And honestly, we've seen a lot of PE fund actors say, we don't care. We're just going to proceed and take the risk. And we haven't really seen any enforcement actions there quite yet. Just a couple of weeks ago, the Rhode Island legislature was considering a bill that would have completely outlawed the friendly PC MSO model in the state. PE showed up in droves, and we're seeing a likely either watering down or completely dying of the bill. And if you had asked me a month ago what I would have expected, I probably would have thought it would have passed. So, in short, to John's point, and attorneys are always the ones who make everyone nervous. A lot of my clients were really spun up about these laws. And, this may change in the future, but as of now, it hasn't really been a huge issue.
Is there anything that currently makes you nervous about any state actions right now, Bill?
So, one trend that I've seen that has not been great is several states now prohibit physician or in some states NP and PA non-competes. And if you're a PE buyer and you've got a 5-year non-compete within a purchase agreement, after those 5 years in states like Indiana, Rhode Island, it's very hard to lock up a physician. We were worried that was going to chill M&A activity. It hasn't. I think a lot of PE acquirers have found new creative ways around those laws. So, for example, we've seen some PE funds issue equity grants to physicians that have non-competes because non-competes in an equity-based agreement in several states do not apply, or I should say, the law does not apply to those. So we've seen a lot of kind of crafty attorneys like myself get around those and make those really non-issues. With respect to AG transaction laws, none that scare me now. With respect to CPOM laws, there's always a law that's being proposed in the state of, Oregon's has already passed, but in the state of Washington, there's a law that is being proposed that's fairly concerning, but we just don't know where it's going to go.
And if it hasn't chilled PE interest in any of these states so far, then I mean, any effects could be potentially mitigated just from an M&A perspective.
Yeah, I think
Yeah,
that's
I mean,
right.
yeah, it's one of those things where there's a cycle of concern, and at the end of the day,
Yeah.
the money always wins.
Well, that is good to hear.
For some people.
For us who track M&A activity.
Right.
Well, let's dive into some of the sectors that are receiving outsized attention from investors these days. We can see here our year-over-year M&A activity according to the Levin Pro HC database of publicly announced healthcare transactions. We see that on a year-over-year basis, behavioral health saw the biggest jump, went from 72 separate transactions to 104. That activity is still below 2021 and 2022, immediate post-pandemic behavioral health boom. But could we see continued resurgence in this space? Bill, if you want to take that, why or why not could we see behavioral health grow in activity?
Sure. So we're seeing a huge, almost like a second wave of behavioral health M&A, probably not as vibrant as robust rather as it was in 2021 and 2022, but we're still seeing it as a key strategy for many of our PE fund clients. I think that the strategy has shifted a little bit. In the past, we saw investors buy facilities. Now we're seeing investors buy access to labor. As I mentioned before, it's so hard to find clinicians and qualified workforce. There is such a crushing demand in behavioral health that finding licensed therapists, psychiatrists are really hard to find. So we're seeing PE funds shift towards not necessarily trying to find a clinic location, but more just trying to find access to labor, right? So if they find an acquisition target that has a bunch of workforce in place, they'll jump. I think the other reason was the Mental Health Parity and Addiction Equity Act has stepped up audits of insurance companies that are either denying coverage or are not including fair, insurance coverage in their plan. I will say, recently we've heard from the Trump administration that they weren't going to enforce this act, which was really a shame. The good news is we have seen some states say that they will enforce it on a state level, either through their own laws or just by saying we're going to enforce it. We're going to we're going to choose to enforce this act regardless. And in states that are choosing to do so, because insurance coverage for behavioral health will be broad and wide, that's where we see the most robust M&A behavioral health activity.
Yeah. And Matt, of the behavioral health subsectors, which are you seeing kind of attract the most attention from investors, and maybe which ones are commanding the highest premiums?
Yeah, so I think we're seeing a lot in ABA therapy, and there's a lot of different types of companies there. It could be, in clinic, it could be in schools, it could be in, regional centers. But ABA therapy is definitely a hot sector that will continue to be active for some time. Inpatient and outpatient substance use disorder companies certainly seeing a lot of activity there. What we're seeing command the higher multiples is going to be companies that have more of a commercial payer mix versus the more of a governmental payer mix. I mean, we're seeing two companies where one company might have 3 times as many beds as the another company doing the same services, but the company with a third as many beds, the EBITDA is actually significantly higher, and the multiple is also higher too. We also saw, when the big beautiful bill got announced, I think we had 3 buy side processes just absolutely halt on deals that had a lot of governmental payer exposure. I'd also say, from a mental health perspective, TMS therapy, certainly been hearing, that's a attractive sector for buyers to get into, and it's because margin profiles are generally better. The reimbursement rate associated with those services also generally better than not having that service offering. I'd say the other thing that's been, as far as getting strong multiples is just out of network exposure. Just in general, buyers have just not really been very, jumping for joy to get, out of network exposure. They really want to value the companies on, in network rates, whether it is, looking at the entire last few years at in-network rates, if you're in process of converting to in-network rates, or it's like, hey, we're not really changing to in-network rates yet, but a buyer's only going to underwrite to to a in-network rate, a market in-network rate based on market studies and things like that. So I would say, in general, looking at companies in a variety of, behavioral health spaces that have a lot of out of network exposure, they're just going to get a lot less attention.
Yeah. And then Bill, behavioral health recently got some attention from the Wall Street Journal in a story that highlighted the kind of particularly high investor interest, but also reimbursement rates for autism services. Could a spotlight like that from a national publication, does that factor into investor interest at all? Does it perhaps lessen it because it could shine a spotlight on somewhere where the federal government may want to reduce reimbursement rates, or could it increase appetite for those kind of deals because of how profitable it can be?
So I think it's almost certainly a headwind. And I think the one step in between that happens is that first, the press will release an article like this. Second, you'll see a regulatory response. And third, you'll see investors getting very nervous. So, for example, when the New England compounding pharmacy had its deaths several years ago, the first thing that happened was a new layer of regulation. And then the industry completely died, or almost completely died, with respect to M&A. Same thing occurred with prescribing of online controlled substances. There was an article in, I think it was the New York Times or Wall Street Journal, about a few children who unfortunately died because they received either ADHD prescriptions or other sorts of controlled substances prescriptions. And that article prompted several states to yank the ability for prescribers to prescribe controlled substances over the internet. So I think much like those circumstances, I think that article will have a profound effect on how state law, particularly Medicaid agencies, reimburse for and audit ABA therapy. You're already starting to see states like Indiana, and I think Indiana for sure, maybe Colorado as well. I think that's right. I think they've proposed caps on lifetime treatment hours as well as rate cuts as a way to substantially reduce their outlay because ABA therapy is significantly, it's just it's extremely costly for a Medicaid program. We're also seeing commercial payers using AI to audit the medical necessity of ABA therapy. We're seeing that in both diagnoses, which I think we can all agree have gotten a little loose over the years, as well as challenging the standard 40 hours per week treatment model. We're seeing more third-party payers say children should really be discharged far earlier than they are now. And I think you'll start to see that happening more and more on the state law level. And I think it will probably result in a chilling of the M&A market for ABA therapy.
Yeah. And perhaps redirect it to other behavioral subsectors.
Correct. And I could see something like, and this is not my favorite sector, so I'm sorry if anyone who's listening on the call is in this sector, but like Spravato, ketamine, we get calls from people all the time saying, we want to start a Spravato clinic. And I always say, all right, it's very risky, and here's why. But we're just seeing a ton of interest in that space, mainly because Medicare reimbursement for it is substantial. So I think that's an area that we'll see a tremendous amount of interest in. Then, unfortunately, something horrible will probably happen, and everybody will pull back, just like the regular cycle.
Oh, sounds like fun. Well, let's touch on home health briefly. We see here in this chart that home health saw a modest 13% year-over-year increase in its M&A activity in 2025. But how are you guys seeing, like, I guess, what is different about the home health businesses that are being put up for sale today versus a few years ago, if there is any difference? Matt, do you want to take that?
I mean, I think home health, from my understanding, is still pretty fragmented. There's some large players, but it's still pretty fragmented. With the just the overall trend of aging population, there's going to be quite a need for home health and hospice for the foreseeable future. Um, I would expect this trend to continue, maybe modest upticks, year over year, maybe some larger players getting involved. But also seeing more of a trend towards home care as well. And that's, essentially home health services that are not, you're not required to be licensed, and it's cash pay only. Buyers like the ability, similar to the big trends in, med spa, right? Healthcare service-esque, where, you can control your prices and you're not, subject to, payer rates, right? So definitely seeing just, if folks can get exposure to tangential healthcare services, but it's a cash pay model, seeing some trends towards that as well.
Yeah. Especially as the cost of seniors housing continues to rise, just with the lack of new development in that space. That's surely going to leave an opening for maybe a more flexible home care model like that. All right, fantastic. Bill and John, anything else you want to add to home health, or do you want to move on to?
Yeah, I think the only thing I would add is during the real home health boom years of 21 and 22, what we saw were a lot of smaller deals where the sellers were super unsophisticated, had either no management workforce in place or just frankly shady operations. And I think we've seen a lot of those deals go bust during the integration process. And as a result, now that we're in 2026, what I'm hearing and seeing a little bit is more of an emphasis on chunkier, more professional assets that have sophisticated workforce in place, less shadiness, and not the smaller operations where it's a doctor who owns it and the spouse runs the books, and it's just very, very hard to successfully integrate that asset into a larger operation without things going wrong.
Yeah. Does that mean that there are just fewer, less attractive deals for prospective buyers in that space?
Well, I think what we are seeing are heavy interest in the larger assets. We're actually seeing, multiples be pushed up. We're, seeing some really competitive bidding processes, but fewer large assets obviously means that generally speaking, it's a softer market, and it gets particularly soft when you go down to like $1 to $3 million in EBITDA.
Yeah. All right.
Yeah, and real quick, while we're on that slide, if you don't mind flipping right back, just one of the questions that I saw in the chat related to the decrease in the surgery center volume,
Mhm.
year over year. I would imagine, I'm not sure exactly how these metrics were counted, but I would imagine there's a lot of surgery centers included within the physician medical groups line as well. And the surgery centers listed here, it's probably
Mhm.
just discrete surgery centers. It would be my guess, because we certainly are seeing deals being done with surgery centers pretty frequently right now. But I'd imagine it's a physician practice with a surgery center. I would
Yeah.
imagine those metrics are being counted up in the physician medical groups line, would be my guess.
Yes,
I
you'd
would
be
agree with
correct.
that. Yeah, especially because there are so many procedures that are being added to the ASC list that
Mhm.
were ordinarily only allowed to be performed by CMS in a hospital. I'm shocked by that, and I would think that you would have a much more robust ASC M&A, you know, market. And I think you're probably right. It's because so many of the ASC acquisitions are ortho groups, cardiology groups, et cetera, that already own the ASCs.
No, I think it's absolutely partially a classification thing, just with the way this M&A data is presented. But very soon we'll come out with a report that kind of further breaks down that the ASC just outpatient market, and we'll be able to kind of, I guess, have a more accurate representation of uh, how active that market is right now. But good point. All right, well, let's move on to private equity. It is still down from an activity standpoint and also a just dollars spent standpoint from 21, 22. Um, John, will we ever see those heights again immediately post pandemic, the private equity interest in healthcare M&A? What do you think?
Ever, probably.
Mhm.
Um, I mean, there was a big wave of like physician practice consolidation in the 90s, and some of those things didn't work out so well. And, PE went into hiding and reemerged in sort of the 20 teens. And so I think, big picture, big economic cycles and sort of thought process around this. I think someday there will be probably, that type of activity. But the reality is the last, handful of years have been a shakeout a little bit from a private equity standpoint. I think, if there's 15,000 private equity firms in the world, or whatever the number is, somewhere in that ballpark, there may have been 1,000 at one point that were, seriously looking at healthcare services deals, in particular provider deals with reimbursement risk and, everything else that you have to think about when you're thinking about investing in a healthcare provider, healthcare services business. And um, I think there were a lot of folks who just decided that that wasn't, from a private equity standpoint, where they wanted to spend their time. There were easier ways to make money, or, things that they understood better based on past experiences, or, their bench of resources and board members and things of that nature, just fit a different mold. And so I think there were definitely a number of private equity firms who said, we'll leave it to the professionals, if you will. Now, that being said, there are quite a few firms still interested in healthcare services investing. I think the firms who are left are super educated in terms of what they're looking for, what they're not looking for. They understand compliance, they understand reimbursement, they understand, revenue cycle, they understand recruiting and the supply and demand imbalance of, physicians and, even in mid-levels and really any type of provider in this market. And so, like Bill was talking about earlier, that, in some ways, some acquisition activity is being driven just by access to the folks who can provide this care. So to directly answer your question, I think, it's possible we see that again someday in terms of number of private equity platform deals in the space. I think we're probably in a little bit of a new normal. There still are, a good 100 to 250 private equity groups who know what they're doing in the space and will continue to be active. I think the other element you're seeing a little bit, and I touched on it before briefly, is portfolio allocation, right? So if you're a pure healthcare services fund, that's easy. But if you're a healthcare fund that does some med device and some pharma services and some, healthcare providers, or you're even more generalist than that and you're doing, industrials and consumer and healthcare, there's a certain level of allocation of your fund that you can put into, any given subsector. And if you're quote unquote spoken for in healthcare services right now because you have the platforms that, you've allocated those dollars to, until you go and, monetize that asset, you might be in kind of a holding pattern waiting for that next deal. There's a number of private equity firms that we speak to that have told us that, hey, we are going to do another healthcare services platform, just, waiting for the next fund or waiting until we, launch one of these, and hopefully have a really nice outcome and so on and so forth. So I think that's kind of where we are from a private equity standpoint.
Mhm.
The investor's still standing, and I'd be interested, Matt and Bill have more buy side clients than I do, more private equity clients than I do, but I think that what you're seeing is a very thoughtful, very intentional approach to those, for those groups who are looking at healthcare services investments in particular, PPM and related sort of subsectors of healthcare services.
Yeah. Matt, where do you think PE is going to kind of home in on in the next 12 months, let's say? Which sectors, which subsectors? And
I
then
mean, I
maybe
think
where that what will they abandon?
Yeah, well, I mean, it's funny. We hear a lot of folks say, "Hey, we're not going to do any more, PPM deals." Clearly, they're still happening. We're actually working with John's team on one right now that should hopefully close, in the next 3 or 4 weeks. And we're probably working on more PPM deals than we have right now in the last 3 years combined.
Mhm.
I think the trends are, a lot of there's probably not as many new entrants into the PPM world, but there certainly are, good success stories around like, RCA, the Webster's platform in the retina space going to Syncora, right? That was a massive, massive exit, and I'm sure a great outcome for everyone who was involved there. Um, but I think there's probably less folks that are willing to go and start new PPM platforms that haven't done it in the past. Or, the other thing is folks that already have, a platform in the space. They're going to continue to do deals. That was the strategy on the onset of when they started the platform, and they're going to keep doing deals. We're hearing people saying, they're less excited about PPMs and more excited about behavioral health. Some of that's just due to the complexities around working with, 25 different partners that are all, physicians as well in their day-to-day jobs, trying to get a new partner, as opposed to going and buying, maybe a substance use disorder clinic where there's one or two owners that you have to deal with, and they're not actually the ones seeing patients, day to day. So I think, that's, I would say that's a trend, but like of what people are saying when I talk to them, but clearly there's still quite a bit of activity, and we're working on, probably more PPM deals than we have in the last several years. So it's a little bit of a mixed message there. Also, our sample size is probably a little bit skewed, but we're seeing, activity in neurology, orthopedics, dermatology, a handful in that space as well. So certainly still seeing some volume there, but I think in general, folks are excited about, behavioral health. and that's a massive range of services. And then anything where they can get like almost like a recurring revenue model, recurring stream of care. That's exciting for folks as well. And commercial payer mix with high margins. People are going to continue to invest in those spaces, day in day out.
Yeah.
Yeah,
John,
and I would
Bill.
add
Ben,
with
oh,
go
sorry,
ahead,
Bill,
sorry.
go ahead.
So with respect to PPM models that have recurring revenue, one that I've seen a lot of interest in is RPM and CCM. Reimbursement for RPM and CCM is very high, and we've seen a lot of physician practice management companies say we can add that to our existing physician operation. We can make a recurring monthly reimbursement of X almost guaranteed. And reimbursement is so high and the costs are so low that we don't see a way for it to lose. I will tell you my view of RPM and CCM is that it's exciting now, but what CMS is doing right now is what it almost always does, which is they start off with very high reimbursement for a service. The intent there is to get several entrants into that space so that they can sort of test it out, see if it works. And then once the market becomes overcrowded, they substantially drop reimbursement and everyone sort of gets screwed. So if you're doing an RPM CCM approach now and you're seeing the reimbursement and you're seeing the volume and you're seeing the recurring revenue, I think that's great. But I would probably sell pretty soon because I believe CMS, again, will do what it always does, which is essentially drop reimbursement soon. But that's about the only recurring revenue model that's in the physician practice management space that's currently working.
Hmm. Bill, do you see like any amount of time where like essentially the good times last until CMS discovers that it's maybe overpaying for a certain service and then those get cut? Because listeners may want to know, all right, if I have to sell now, like how much time do I have before CMS realizes it? Like, do I get 2 years of it being the good times and then it all changing? Have you ever noticed any amount of time over the years of looking at that?
No, I mean, it's sort of all over the board. Like, it'll either be started by a journalist like the Wall Street Journal, releasing an article, or it'll be like an HHS OIG report that says that the area is rife with fraud, and
Yeah.
then CMS will respond accordingly. But it's honestly really all over the map. So I wish I could say, but I don't really have a good prediction there.
That would have been too good to be true if you did.
Yeah, we lawyers don't like to commit to anything, so I won't hear.
All right, I'll wait till after the call then.
Right.
John, anything to add on the PE world before we move on to hospitals and health systems?
Yeah, no, it's interesting, like the and Matt sort of touched on this, but I think a lot of the headlines, people are sort of chasing the new thing, right? What's the next
Yeah.
specialty to invest in? How do we play physician practices without owning the practice itself? Whatever it might be, like there's a lot of talk about the new flashy areas to invest, and that's all well and good. But I think it's as interesting to see the groups that are looking backwards at where they had success, saying, how can I do that again? Right. And so you saw that, for example, like in dental quite a bit. There were many private equity firms who had, you know, a US dental platform and then maybe they went up to Canada and did it, or they had a US dental platform and did it again, right? And have had multiple successes in the specialty. We're even starting to see, that the older specialties from a private equity investing standpoint, the more retail specialties like dermatology and ophthalmology, we're seeing, new platforms be formed up there. right? And that's something that, I'm not so sure that we ever thought would happen.
Hmm.
But there's ophthalmology platforms that have been around for a year or less at this point, and there's still a lot of big groups. Like we spend the majority of our time in founder-owned first institutional capital situations. There's still big groups out there in those specialties that could easily be platforms just from like a bottom line EBITDA standpoint, infrastructure. They sort of held out and built quietly in the background, and so there's opportunities there for the investors who have done it before and I think are interested in following playbooks that work, leveraging those people and those resources that that have that experience to be successful. And I
Hmm.
think a lot of it too is for the private equity folks who might be listening here, I hope would agree with this. The fundamental like investment thesis behind physician practice management, for example, hasn't changed, right? It's getting incredibly hard for these doctors to run these businesses. It's complicated. It's, reimbursements getting cut, expenses are going up. Like the themes and the attributes of these transactions that make them appealing to private equity to go create scale, build that back office, invest in some business acumen to supplement the clinical side, and really enable those clinicians to see more patients, spend more time with them, make them better. That's all still good thesis, right? It's just there's been some practical execution errors. There's been some, a lot of times that's in integration and the idea that you're cobbling together a bunch of EBITDA and not really building a business in the back end, right? I think most investors have learned that lesson now. And what, the theme we're seeing is you got to have integration. You got to build something on the back end that actually has a value proposition to it.
Hmm.
And for the investors who understand that, the private equity folks who understand that, there's still a lot of work to do there. And so I think, like to Matt's point, you're not going to see this go away. There are fewer investors pursuing these strategies, but the ones who, have that playbook and have, the people to lean on and the resources and so on and so forth, I think will continue to do so for, at least the foreseeable future.
Yeah. Well, you need a buyer and a seller to agree on a price to have a deal too. So that it's not just perhaps waning interest among the buyers that can explain a drop in M&A
No doubt.
activity. Yeah. All right, let's touch on hospitals just briefly. If we look at this hospital M&A chart, we'll see that the number of transactions has been very consistent, but the number of hospitals involved in transactions within each year has been dropping precipitously ever since 2022. Bill, what's going on here? Uh, I guess how can you explain this chart?
Yeah, I mean, my personal experience is like there's sort of this not death, but near death of like the system to system mega merger where you've got huge system A that buys huge system B. I know that recently Sutter and Alina just announced that they are in fact merging, so that obviously completely refutes what I just said. But generally speaking, I would say that what we're seeing are far fewer of the mega deals that we used to work on. And what we're now seeing are onesie, twosie health system deals where you've got a struggling, you know, critical access hospital that was completely destroyed by Trump's legislation because of cuts in Medicaid and dish percentage issues. So we've seen that occur a bit, but there's also just a huge liquidity crunch with hospitals. Hospitals don't have, I mean, they claim they do. I always think they do, but they always say they don't have any money. So where, in 2015, 16, 17, 18, you would see these huge transactions where the buyer or the member substituter, if you will, would contribute millions or hundred millions of dollars of capital to inject into a system that it was acquiring or merging with. They don't have that capital anymore. So we're not seeing these huge deals. We're seeing smaller deals where financially distressed rural hospitals are essentially waving the white flag and saying, if someone doesn't buy us, we're just going to close. But
Mhm.
other than that, I think that's why.
Yeah, and Ben, just for the for all of our edification, that last slide, that's hospitals buying other hospitals, right? That's not including hospitals buying a physician group or buying a surgery center or something like that, right?
It's any firm buying hospitals. So
Right.
that they tend to be
So
health
yeah, so I
systems
mean, I
hospitals. Yeah.
think just to
This
piggyback on what Bill
slide is
said,
this slide is M&A with hospitals as the buyer or health systems as the buyer.
right? Yeah, so this is where I was sort of going anyway, is that with the non-hospital deals, like you'll
Yeah.
see shift to outpatient, right? You can see that right here. They're if you're a hospital or a health system buying something today, you're probably not buying another tower, right? You're probably and I think a lot of those deals and some of those trends you saw on the last slide where you're seeing the deals sort of level, but the number of hospitals involved shrinking. I think a lot of, at least like I live in the Chicago market, there have been some acquisitions here of hospitals or small health systems with numerous facilities where the ultimate outcome is that they're sort of reassessing need and a lot of times, unfortunately, closing down hospitals because they had more than they needed for the market or, the demand or whatever. And number one, and number two, if you are going to buy something in your hospital health system right now, you're looking at the surgery centers, you're looking at the outpatient setting, knowing that that's where things are going, trying to get in front of that in a way, probably. Obviously, there's some level of, I mean, there's always going to be a need for a hospital in an inpatient setting, right, at some level. But
Yeah.
as more procedures, to what Bill mentioned earlier, shift to the outpatient list and things like that, I think the strategy is changing. And so what a health system would want to buy is no different than what a private equity firm would want to buy today, right?
Mhm.
It's the physician groups and the the outpatient facilities, the things that make sense in today's environment and where things are going.
Yeah. And Matt, are hospitals looking to alternatives beyond traditional M&A to grow in these outpatient areas or whatever ancillary businesses they're looking to grow in?
Yeah. So I think a couple things that I can chime in on here. So I mean, I think the more that most of the activity that we've seen or interest from our group has been more of like primary care groups that are filter systems, having interest into looking into those from hospital M&A activity. And then the other thing is not necessarily in health or hospital deals, um, more so strategies the hospitals are going down to increase their margins by outsourcing services that they currently in-house. So that
Yeah.
might be some of the care coordination stuff or radiology services or a wide variety of other companies that just only focus on that that vertical coming in, and it's kind of a win-win for both parties where the hospital doesn't have to deal with it anymore. They're going to pay a good number to the radiology company or whoever we're talking about here. They're making good money, but if they were really just trying to keep it all in house, it's just too challenging for them, and they're losing money on those types of situations. So seeing more activity into services into hospitals, both on the buy side and the sell side, but not necessarily as much activity with our small sample size of hospitals necessarily
Yeah.
doing the deals themselves, but rather trying to strengthen their EBITDA profile and earnings profile by outsourcing some of these services for some sort of synergistic win-win for kind of both parties.
Yeah.
Yeah, and
And then yeah.
I would add to that just real fast that I completely agree. And one other thing that I've seen is hospitals hospitals realizing that they do certain things very well and certain things they do not do very well. So, like an example is therapy, um, particularly OT, PT, and SLP. Hospitals don't know how to do it well. So what I've seen a lot of are hospital therapy JVs,
Mhm.
where therapy operation is able to use the hospital's very rich third-party payer rates, and the hospital is able to leverage the therapy company's operational excellence. And if you do it right, it can be a very successful venture.
Yeah. No, great point. We are already an hour through. I want to make sure we have enough time to talk about the physician medical group space. So, John, I'll direct this next one to you. Doctors groups, uh, M&A is still very active in that space, but it's still off of 2022 and 2023. Why will activity go up or down in 2026?
Well, I think first of all, we're expecting 2026 to be an up year from
Mhm.
25. I just,
For PGP itself or for the sector?
well, using
Both.
PGP's kind of book of business and just activity relative to prior years, to kind of proxy the market. I guess both.
Mhm.
But, I think we are in a market where you've seen some trades happen that were sort of we were all waiting for, right? Some of the ophthalmology groups, the GI urology groups that, went distributor. There have been some private equity to private equity second bites. And like I mentioned earlier, as the backlog of platforms continues to reset, fresh capital, et cetera, see the monetization or creation of value on the second bites, all of these kinds of things, that prophecy will fulfill itself in terms of additional volume. And then when you look at the groups like, that we work with, the independent groups, they're looking at that activity and saying, okay, now, might be the right time for me to get back in the mix because, X, Y, and Z buyers have fresh capital. It might be, hey, I feel like we've rebounded from whatever happened, the COVID implications of my practice. I took a hit in 2021 and 2022, and that wasn't the right time for me to sell. Valuations got wonky as interest rates started to move around. And
Yeah.
now today we're in a stable, we've reached stability in the practice. Valuations in the market are in a good spot. Um, let's go out and explore. And oh, by the way, running my practice has gotten no easier over the last 5 years, whether I did a deal in 21 or I'm still waiting to do my deal. I'm still arguing with payers. I'm still trying to find and recruit providers. I'm still, trying to collect every, percentage point of my bill charges as I can. Um, all of those, pressure points are still there. And so I think you're seeing a lot of practices who have tried to hold out, look at the market right now and say, this is probably the time. So we feel like this will be an up year from a PPM standpoint, when it's all said and done.
And which of the specialties do you see kind of contributing the most? Looking at this graph, this is just the top specialties that we're tracking, and dental should probably be its own category at this point. But which specialties do you see kind of driving more of the activity in 2026?
Yeah, look, like I said earlier, eye care and dermatology, I still think are, there are strong platforms in the space in each of those specialties as far as buyers go. There's still a number of independent groups who have, a lot of them wanted to just sort of see what happened, right? And now they've got enough data retrospectively to look back and say, is this something that I want to do? And what are the questions I want to ask when I do it to ultimately find the right partner? So I still think eye care, dermatology are going to continue to be busy. Orthopedics and MSK, broadly speaking, when you include things like pain management and physical therapy, the whole spectrum of MSK, I think
Yeah.
continue is that space slowed down for a minute. There were a bunch of groups that sort of went all in on orthopedics all at once, and then they had to take a minute to sort of realize what they had and how are they going to put all the pieces together. We're on the other side of that now, I think, for a lot of these platforms. And so you have a lot of these groups from a buyer standpoint being very active, and you have the sellers saying, okay, now I sort of see how this works. I see some, some good, some bad, some ugly. I know what to look for, what to ask, and can find the right partner. And then I think, you're seeing kind of revitalization in things like urology and GI with some of the bigger transactions that have happened on the distributor side. So those specialties I think are going to be, active. And then plastic surgery is another area where we, as a firm are seeing quite a bit of interest, aesthetics broadly speaking, from plastic surgery to med spa and Botox and things like that. The economy, I think there's some question marks in certain pockets of the economy. But I think by and large, you tend to see, and for the groups who have invested in, aesthetic medicine, you tend to see an allocation of capital there from, personal pocketbooks, regardless of the economy, meaning, for a long time, there was a question around, in plastic surgery, what happens in a recession? I think a lot of that has been answered, over the last several years where we've had a little bit of up and down, and you have still continued to see, patient demand. It's not perfect. It's not totally counter-cyclical, but it's a little bit to maybe quite a bit more insulated from the broader market than some folks would expect. And so we see that driving activity. You're also seeing quite a bit of dermatology platform investment into the plastic surgery side as sort of a supplemental
Yeah.
service offering, a cash pay service offering to balance out some of the reimbursed work, et cetera, et cetera. So that's a specialty that we expect to see, continued activity as well.
Yeah.
I feel like
And
med spa is like urgent care, like 5 or 6 years ago, where everybody was investing in urgent care, and you saw an urgent care on every other block.
mhm,
And obviously, the urgent care space is not dead, but close to dead. I think that's going to happen to med spa in the future. I We see so much activity in the med spa space. We see so much geographic concentration of them that I don't know how long that space is going to be sustainable, particularly because when you can have estheticians and RNs do so much of the work that you don't have constraints like you do in like the ophthalmology space, where there's only so many ophthalmologists a year. I see that space in the next couple years imploding. That's my kind of bold prediction today, and I'm sure you'll play it back 2 years later when I'm wrong. But that's my bold prediction.
Yeah, and I would just say, Bill, on that point, my wife told me last week I need to get Botox. So, at the same time,
increasing demand.
I'll get a hair transplant, and we'll all be good.
Uh, no, but to John's point on kind of just where he's seeing the activity, I mean, I pretty much agree. I mean, the sectors listed here, that's pretty much a similar mix of what we're working on currently. We always have dental deals going on, large dental deals, small dental deals. We always have something going on in the dental space. So yeah, we're certainly seeing more activity, and dermatology certainly has been a big one as well lately.
Yeah. And then Matt, for underwriting physician group deals, what metrics have you seen matter the most when underwriting organic growth, looking at these businesses?
Yeah, I mean, looking at encounter trends and procedure trends by individual providers and locations, certainly an important metric to look at. Kind of more of like a same store year over year kind of growth. I think is something that people focus on. Reimbursement rates, can be, pretty important, but at the same time, depending on who the buyer is, that might just be, some sort of synergy, opportunity. But definitely, important on the forefront. So I mean, I think those are kind of some of the main ones to look at. Um, and probably just the growth profile, growth and margin profile. I
Yeah.
think it's just far more attractive when you're talking about, a 20% plus margin profile in a special, in certain specialties compared to, a 5% margin profile that's, not necessarily growing. And a lot of that has to do with, payer mix considerations.
Yeah. And John, from the seller's perspective, what are some of the biggest drags on value that they should be aware of as they're contemplating a sale?
Um, okay, so a couple. If you are a shareholder in your practice and you are, call it over 60 years old, that is, you really want to be able to look someone in the eye and say, I can commit to at least 5 years if you want to sort of maximize value, right? And you're sort of signing up for that minimum commitment, unless you have a backup plan or a replacement already lined up. You can inadvertently wait too long to sell your practice, and then all of a sudden there's going to be a flurry of questions about who's going to backfill that volume, particularly if you're on the tail end of your career and a high producer, which often are correlated.
Mhm.
Um, I think, if you have had recent turnover, it's going to be difficult going all the way back to like the beginning of this webinar. Matt touched on this a little bit. This idea of run rating or getting pro forma credit for either new or in particular replacement providers, you really, you wouldn't want to go to market having recently lost one. You want to be able to say, okay, I replaced this person. They're working in our organization. You know, they're getting along with everyone. And then, oh, by the way, they're producing at or above the level of the person they replaced, right? That can really blow a hole in the process. And also, if you're getting into a process, you want to make sure that you have little to no risk of that happening in the middle of a sell side transaction process. Um, and then, I think there's some things that you sort of can't avoid. There's some state-based things like Bill and I talked about in terms of regulations that you just have to be aware of. And ideally, if you are in one of those states where there's some regulatory things perking up, you have sort of a bead on the lobbies and the folks that, will sway those decisions so that by the time can have to answer that question with someone, you can do that. Um, but yeah, I think those are kind of the big ones that we see. It's really it's volume, revenue, turnover, and then making sure that you're in the right place in your career when it does come time to sell. And if you're, later in that progression, make sure that you have the backup plan already figured out.
Yeah.
Yeah, I'm sure, John, you run into it all the time where folks don't realize they can sell and walk out the door the next day.
Right.
It's always funny when that's what people think that's kind of how it works. But just one other thing to add on some of that, going back to kind of the physician practice valuation kind of levers. I mean, I think the other thing I don't think we talked about as much is just kind of the breadth of ancillary offerings.
Mm.
Certainly being a big lever into kind of the valuations, and then also just the ASC. If you have an ASC, those are all, typically highly profitable pieces of the business as well. So when we're talking about just what's commanding maybe higher valuation and multiples, those are certainly going to be some of the bigger triggers.
Yeah.
And if you're also dependent on like really high margin individual procedures, if you will. So, for example, like skin substitutes is one that, at this point has kind of come and run its course. There was actually another Wall Street Journal article about, the world's most expensive Band-Aids and that kind of thing. But being cognizant of pockets of risk within your practice that are highly dependent on a given provider, a given procedure, a certain payer contract, whatever it might be. Those can be great things if they can be extrapolated, because you're doing something very well that other people are not doing as well. But if they are, on the other end of that spectrum and they're, stroke of the pen risk kind of a thing, that can be problematic.
Yeah. All right.
Yeah.
Well, we've got 2 minutes left, so I just want to end with our last question, and we'll kind of make it a rapid fire, with just a couple of sentences each. So I want each of you to tell me how will the 2026 M&A market be different from 2025? That's it. Very broad, but Matt, do you want to start us off?
Yeah, I mean, in the most simplistic terms, I feel like just from talking to our clients and the just the inbound interest on new sell side engagements as well, we're expecting there to be a material uptick in volume from 2025. At the same time, it's sometimes hard for us to necessarily tell what's market dynamics and what's us just working with new clients as we've grown over the last few years. But I think I think without a shadow of a doubt, I would imagine 2026 is going to be significantly a higher volume across the board than 2025.
Good to hear. John, you want to go next?
Yeah, I mean, I agree with all of that. We definitely feel like volume will be up this year. I think you will see um, increased scrutiny and or just more educated and informed decision making around, whether it be pro forma adjustments, whether it be, the specialties that we see, just a finer tooth comb as, investors have gotten extremely sophisticated in how they evaluate M&A deals.
Mhm.
And I think lastly, I don't know if we could go a whole webinar without saying AI. We almost did, but
Oh,
there's going to be some, I'm not going to pretend that I know what it's going to be, but there will be some impact of AI on healthcare services. I think most folks would tell you that the most impactful area of that will probably be on healthcare IT revenue cycle, and some, opportunities to save on cost there. But we'll probably start to see that play out. We haven't seen a ton of it yet, but I expect we will.
Bill, you want to take us home?
yeah, I'm going to be very quick. I'm going to zag. Nothing new under the sun. It's going to be very similar to 25. And AI, I think, does not have a material impact on PPM or anything in healthcare other than like the RCM space or the scribe space yet. And I think monumental shifts are coming, but I don't see any on the horizon. I see a lot of um, healthcare transaction bills and CPOM bills that are going to die, and I think nothing new under the sun. It's
All
my hot
right.
take.
That's bold. But no, I love it. Well, Bill, John, Matt, thank you so much for a fantastic conversation. The 75 minutes just flew by, and each section could very well be its own 3-hour webinar. But Matt, I appreciate you jumping on with 24 hours notice.
Absolutely.
Thanks, man.
Bill and John, thank you so much for the pre-calls and all the prep too. I had a lot of fun. This is not going to be our last webinar either, so hopefully we'll do it again in the future. And to all of our listeners, also thank you in advance for filling out that survey that appears at the end. But Bill, Matt, John, thank you so much. This was fun.